Welcome to The Explainer. When you first look at a financial chart, it can just seem like, well, a bunch of noise, right? Pure chaos. But what if there's a story hidden in those squiggly lines? A whole language waiting to be read? Well, today, we're going to learn how to do just that.
Yeah, it's so easy to dismiss it as just random noise, like static on a TV screen. But for, over 100 years now, there's been this whole group of people, market watchers, who say, no, wait a minute, it's not noise at all. They believe there's a real story in that data, a story about human behavior playing out in real time.
So, how do they read the story? Well, the method they use is called technical analysis. And really, it's just what it sounds like. It's the practice of studying price movements on a chart to try and figure out where the market might go next. The key thing to remember here is that it's all about the what, the price itself, not the why behind it. Okay, so before you think this is all about gazing into some crystal ball, let's be clear, it's not. Technical analysis is actually built on a pretty solid foundation. It's a philosophy, really, based on three core ideas that are, surprisingly simple once you get them.
All right, these three ideas are basically the bedrock of the whole field. So let's dive in and break down each one. First up, and this one is huge, is the idea that the market discounts everything. Now, that's a powerful concept. It basically means that everything, and I mean everything, that could possibly affect a stock's price is already reflected or baked into the price you see on the screen. Think about it. Earnings reports, political news, a new competitor, heck, even just how investors are feeling. It's all in there. For a technician, the price is the ultimate truth.
Okay, number two, prices move in trends. I mean, this is the whole reason we even look at charts, right? The core belief here is that once a trend gets going, doesn't matter if it's up or down, it's way more likely to keep going in that direction than it is to just stop on a dime and reverse. It's kind of like Newton's first law of motion, but for the market. An object in motion tends to stay in motion. And here's a perfect example of what we're talking about. Look at this chart of the S&P 500. See that? The price isn't just bouncing all over the place like a pinball. No, it's moving in a clear, sustained upward direction for a long, long time. It really does show you that an object in motion tends to stay in motion. And that brings us to the third and final idea. History repeats itself. Now, you might be asking, why would it? Why would history repeat in the markets? Well, the thinking goes like this. These chart patterns we see, they're basically just pictures of human psychology in action. And even though times change, the things that drive us, fear, greed, hope, they don't really change. So the patterns that showed up 100 years ago can absolutely show up today because deep down, we tend to react the same way to the same kind of situations. All right, so if technicians are all about the chart, you're probably wondering, how does that compare to the other big way of looking at the market, which is fundamental analysis?
Yeah, it's a classic debate for sure, but it really just boils down to one simple difference. A fundamental analyst, they want to know why the price is moving, so they'll be digging into all the details, company earnings, economic data, that kind of thing. But a technical analyst, they say, look, all that why stuff is already in the price. So they just study the what, the price movement itself. One studies the cause, the other studies the effect. Simple as that. Okay, let's build on that foundation now and talk about what is, without a doubt, the most important concept for any technical analyst, the trend. Seriously, if you get this part right, you're halfway there. But if you get it wrong, well, not much else is going to help you. So what is a trend anyway? Well, in the simplest possible terms, it's just the direction of the zigzags you see on the chart. See, markets don't move in a straight line. They move in waves, right? They make these little peaks and valleys, or troughs. And the overall direction of those peaks and troughs, that's your trend. And the beautiful thing is just how simple this is to see. Look here. An uptrend, that's just a series of higher peaks and higher valleys. It literally looks like you're climbing a staircase. And a downtrend is the exact opposite. A series of lower peaks and lower valleys, like you're walking down a staircase. It's that dead simple visual that makes trend analysis so powerful. And here's what it looks like on a real chart, out in the wild, so to speak. You can see it as clear as day. The market's in a downtrend, right? Then it kind of goes sideways for a bit. We call that consolidation. And then bam, it breaks out into a brand new uptrend. You can literally watch the entire mood of the market shifting right there on your screen. One of the pioneers of all this, a guy named Charles Dow, he came up with a really great analogy for this. He said trends are just like the ocean.
You've got the primary trend, that's the main tide, lasting a year or even more. Then inside that tide, you've got the intermediate trends. Those are the waves, lasting, say, a few weeks to a few months. And then even smaller, you have the minor trends, the little ripples on top of the waves, lasting just a few weeks.
All right, so we get trends. But what actually defines them? Where are the lines in the sand, the key battlegrounds where buyers and sellers are really duking it out for control?
Well, that's where two really important ideas come into play: support and resistance. The easiest way to think about it is this. Support is a price floor. It's a level where buyers just seem to come out of the woodwork and say, nope, that's cheap enough, we're buying here, and that demand stops the price from falling. Resistance? That's the opposite. It's a price ceiling. It's where sellers take over and say, that's high enough, time to sell, and they stop the price from going up.
But here's where things get really, really interesting. Those floors and ceilings, they're not set in stone. They can and do get broken. And when that happens, well, something pretty cool happens next. Once a price smashes through one of those resistance ceilings, it often does this incredible flip. It transforms and becomes the new support floor. So a place that used to be full of sellers now becomes a place full of buyers. It's a super important concept that technicians call role reversal.
And this isn't just some abstract idea. Check this out. Look at this real-world chart of the NASDAQ 100. See that peak back in late '96? That was a clear ceiling, a resistance level. But watch what happens. Once the market finally punched through it, that exact same level became a solid floor, a new support level, a year later. It's amazing. You're literally watching the psychology of the market shift right before your eyes.
So this is the main takeaway, really. It's not just about drawing random lines on a chart. These patterns, these floors and ceilings, they're not arbitrary at all. They are a direct visual reflection of human behavior. And really, at the end of the day, this quote just nails it. Every single tick up, every tick down, every single pattern that you see forming, it's like a footprint. It's the footprint left behind by millions of people making decisions. It's a visual diary of their collective battles between fear and greed, hope and despair. What is technical analysis then? When you boil it all down, it's really just applied social psychology. And that leaves us with one final big question to think about. When we look at a chart and we see one of these trends or one of these patterns, are we really seeing a roadmap to the future, a predictable path of where prices are headed? Or are we just holding up a mirror to ourselves? Are we just seeing a beautiful and, complex reflection of our own collective mind? The truth? It's probably a little bit of both.